October 2008. Lehman Brothers has just collapsed. The American housing market is a smoking ruin. Every economist, every hedge fund manager, every financial institution in the world is screaming the same thing. The dollar is done. The U.S. borrowed too much, spent too much, printed too much. This is the moment it all comes crashing down. And then something deeply strange happens. Money floods into the United States. Not a trickle, $500 billion in 3 months. Private investors from around the world, watching American financial markets implode in real time, decide that the safest place to put their money is America. U.S. Treasury bond yields actually fall. The dollar doesn't crash. It rises. This is not how financial crises are supposed to work. When a country's economy melts down, investors flee. Capital escapes. The currency collapses. That is the script. Every other country that has ever had a financial crisis has followed the script. The U.S. rewrites it entirely. Why? That's the question economist Eswar Prasad spends an entire book answering. And the answer, it turns out, says something uncomfortable about every country on Earth, including the ones who claim to hate the dollar most. This is the dollar trap. To understand the trap, you have to understand how we built it. The dollar's global dominance doesn't go back as far as people think. For most of the 19th century, the British pound was the world's reserve currency. Sterling was what you held if you wanted safety. Sterling was what you used if you wanted to trade. Britain sat at the center of global finance, and every country kept pounds in their vaults as insurance. Then came 2 world wars, a Great Depression, and the moment where the balance of power shifted permanently. At Bretton Woods in 1944, the Allies designed a new post-war monetary system. Every major currency would be pegged to the US dollar, and the dollar, in turn, would be convertible to gold at a fixed rate of $35 an ounce. The US was the anchor. The dollar was the foundation. That system eventually broke down in 1971, when Nixon suspended gold convertibility. He had to, because the U.S. was running deficits and didn't have enough gold to cover the dollars it was printing. Bretton Woods was over. But here's the thing about the dollar's dominance. It didn't need Bretton Woods. It had taken on a life of its own. By the early 2000s, the dollar is everywhere. About 60% of global foreign exchange reserves are held in dollars. Most international commodity markets, oil, metals, agricultural goods, are priced in dollars. When countries trade with each other, they often settle transactions in dollars, even if America has nothing to do with the deal. The dollar is the air that global finance breathes. And underneath all of this sits a simple reality that Prasad keeps coming back to. The United States has the deepest, most liquid financial markets in the world. When you need to park $100 billion somewhere safe, where do you go? U.S. Treasury bonds are the answer. They're backed by the full faith and credit of the U.S. government. They're easy to buy and sell in massive quantities, and they've never defaulted. There is simply no other market on Earth that can absorb that kind of money without blinking. The Eurozone is fragmented. You found out during the Greek crisis that German bonds and Greek bonds were very different things. Japan has its own challenges. Emerging market bonds are too volatile. Gold is too small and pays no yield. There is, quite literally, no alternative at scale. That insight, no alternative at scale, is the foundation of everything that follows. Here is where Prasad gets genuinely provocative. He calls one of his chapters a $1 trillion con game. And what he describes deserves that name. China is the world's largest creditor nation. It has accumulated over $3 trillion in foreign exchange reserves, mostly through years of trade surpluses. Workers in Chinese factories produce goods. Those goods get exported. Dollars flow in, and the Chinese government parks those dollars somewhere. Where do they park them? U.S. Treasury bonds, mostly. Because, as Chinese officials keep privately admitting, There is nowhere else to put them. Now think about what this actually means. China, a country that by any normal measure should be earning a return on its massive wealth, is instead paying the United States to borrow from it. Because U.S. Treasuries are safe, they offer low yields. China earns close to nothing on its $3 trillion pile. Meanwhile, the U.S. borrows cheaply and invests that money in riskier assets abroad that earn higher returns. In 2012, China, as a net creditor of $1.7 trillion, had a negative net investment income of $57 billion. The United States, a net debtor of $4.4 trillion, had a positive investment income of $206 billion. Let that land. The creditor pays the debtor rakes it in. Prasad gets his hands on some incredible documents to illustrate this. Actual WikiLeaks cables from the U.S. Embassy in Beijing. When Chinese officials privately worry about their dollar exposure, when they suggest they might want to shift some reserves out of treasuries, the U.S. Embassy's confidential assessment is essentially, don't worry, they can't. Their holdings are so enormous that any serious attempt to sell would crash the price of the very bonds they're trying to sell. China would be destroying its own wealth. One senior Chinese banking official put it with memorable bluntness at a conference in New York in 2009. He was asked whether China would keep buying U.S. treasuries. His answer, "We hate you guys. Once you start issuing $1 to $2 trillion, we know the dollar is going to depreciate, so we hate you guys. But there is nothing much we can do." He then listed the alternatives. Gold? The gold market is too small. Japanese bonds, euro bonds, no depth, no liquidity. U.S. treasuries are the safe haven. For everyone, including China, it is the only option. That is the trap. China built it $1 at a time, and now it can't escape. The resentment doesn't stay private for long. In September 2010, Brazil's finance minister Guido Mantega walks onto a stage in Sao Paulo and coins a phrase that will dominate global financial headlines for years. He calls it an international currency war. Here is what he means. The U.S. Federal Reserve, trying to stimulate a sluggish post-crisis economy, is buying hundreds of billions of dollars in bonds, essentially printing money. This is quantitative easing, QE1, and then QE2. The effect of flooding the world with dollars is that the dollar weakens against other currencies. For countries like Brazil, that means their currency gets stronger. And a stronger currency is a disaster for exporters. Their goods become more expensive for foreign buyers. They lose market share, factories close. So Brazil retaliates. It imposes taxes on foreign capital inflows. Other emerging markets follow with their own measures. Countries start competing to keep their currencies weak, because a weak currency means competitive exports, means jobs, means growth. But here is the truly vicious irony that Prasad identifies. When countries intervene to prevent their currencies from rising, when they go into foreign exchange markets and buy dollars to push their own currency back down, they accumulate dollars. And what do you do with all those accumulated dollars? You park them in U.S. treasuries, which makes the dollar stronger, which defeats the entire purpose. Every move countries make to escape the dollar's grip ends up tightening it. The G20 summits of this era become theaters of frustration. World leaders show up, give speeches about the need for coordinated action and global cooperation, and then go home and do exactly what's good for their own countries in the short term. The currency wars continue. The dollar remains entrenched. By this point, the obvious question presents itself. Can't China just build an alternative? China is the world's second largest economy. It is on track to become the largest. Its trade volumes are enormous. If any country can challenge the dollar's dominance, surely it's China. Prasad takes this seriously, and his answer is nuanced. Yes, the renminbi is going to become more important. China is actively pushing for it, encouraging more trade to be settled in renminbi, building offshore renminbi markets in Hong Kong and Singapore and London, lobbying for the renminbi to be included in the IMF's special drawing rights basket. All of this is real progress. But becoming a reserve currency requires things that China doesn't have and can't get quickly. Deep, open financial markets, rule of law, an independent central bank that investors can trust, a convertible currency with no capital controls. These aren't just technical requirements. They are the infrastructure of trust. The fundamental problem is that foreign investors who want to hold renminbi assets need to know they can get their money out. China's capital controls mean you often can't. And even if the controls were lifted tomorrow, building the kind of financial markets that can absorb trillions of dollars in foreign reserves takes decades. U.S. financial markets are what they are because of 2 centuries of institutional development. Prasad sketches what he calls a Trojan horse theory, that smart reformers inside the Chinese government are using the goal of renminbi internationalization as cover to push through domestic financial reforms that the system would otherwise resist. Make the currency global, and you have to liberalize the banking sector, deepen capital markets, let the exchange rate float. The nationalistic objective becomes the vehicle for the economic necessity. It's clever. It might even work. But it won't happen fast enough to displace the dollar in any time frame that matters now. His prediction? The renminbi will become a competitive reserve currency within a decade. It will erode the dollar's dominance, but it will not displace it. So if the dollar is so dominant, why does any of this matter? Why write a book about it? Because Prasad is also honest about the fragility underneath the stability. He invokes the science of self-organized criticality, the sandpile model. Imagine sand grains falling one by one onto a pile. For a long time, nothing dramatic happens. Individual grains land. The pile adjusts. Equilibrium holds. But at some point, the pile reaches a critical state where the addition of a single grain can trigger a massive avalanche. The terrifying part is that from the outside, the pile looks exactly the same before and after it crosses into the critical state. Is the global monetary system already in that critical state? The warning signs are real. U.S. public debt is above 100% of GDP. The political dysfunction around the debt ceiling showed the world that American governance had become less stable and less predictable. Standard & Poor's actually downgraded U.S. government debt in 2011, the first time in history. The rational response should have been capital flight from treasuries. Instead, yields fell. More money flowed in. The downgrade was, paradoxically, a flight to safety event. This keeps happening, and it keeps being strange. When the U.S. has a crisis, money flows into the U.S. When Europe has a crisis, money flows into the U.S. When there's general global panic, money flows into the U.S. The United States has somehow become the insurance policy for a system whose risks it largely creates. What could actually break it? Prasad identifies a few scenarios. A real fiscal crisis, not political theater, but a genuine inability to service the debt, would force a reckoning. A sudden loss of institutional trust would erode the premium that investors pay for dollar assets. And then there's the wild card. China. He walks through the scenario carefully. China holds over $1 trillion in U.S. treasuries. If China were to dump even 10% of those holdings in a short period, it could trigger panic in bond markets. Bond investors, already nervous about high U.S. debt levels, might interpret China's selling as the leading edge of a broader shift and rush to sell before prices fall further. The cascade could be significant. But China can't actually do this. Selling $1 trillion of treasuries would crash the price of those treasuries, destroying the value of China's remaining holdings. the dollar would fall against the renminbi, meaning every bond in China's portfolio would be worth less in domestic currency terms. China would be shooting itself in both feet. It's what Prasad calls an atomic weapon with a nasty recoil. Unless, he adds quietly, politics overrides economics. In his meetings with Chinese officials during a 2008 trip to Beijing, he found them remarkably willing to contemplate economic pain if it meant protecting what they saw as matters of national sovereignty: Taiwan, Tibet, the Diaoyu Islands. China has demonstrated repeatedly that it puts territorial and political considerations above economic optimization. If a sufficiently serious flashpoint emerged, say, a military confrontation over Taiwan, the economic logic of the dollar trap might not hold. That is the genuinely unsettling possibility sitting at the heart of this book. Here is what Prasad ultimately concludes, and it's uncomfortable for almost everyone. The dollar's dominance is not primarily a story of American strength. It is a story of everyone else's weakness. The dollar reigns not because the U.S. has earned it, not because American institutions are so magnificent, not because the U.S. dollar is intrinsically superior, but because the alternatives don't exist at the necessary scale. Every country that resents the dollar, every policymaker who rails against the exorbitant privilege that lets the U.S. borrow cheaply and consume beyond its means, every single one of them is simultaneously trapped into supporting the system they claim to oppose. They accumulate reserves in dollars because they have no choice. They buy treasuries because there is nothing else liquid enough. They intervene to weaken their own currencies and end up strengthening the dollar. Their resistance reinforces the trap. Prasad's framing is almost Greek in its structure. Every action taken to escape creates tighter chains. And here is the contemporary charge to add to his argument, because the book was published in 2014, and the decade since has been clarifying in uncomfortable ways. We have now watched the U.S. weaponize the dollar's dominance explicitly, using sanctions, freezing reserves, cutting countries off from the global payment system. Russia's foreign reserves were frozen after 2022. The message to every government on Earth was unmistakable. The U.S. controls the infrastructure of global finance, and it will use that control when it chooses. Countries heard it. They began diversifying, slowly. China and Russia and others started settling more bilateral trade in non-dollar currencies. Central banks started buying gold at rates not seen since the 1960s. The BRICS countries began talking seriously about alternatives. The de-dollarization conversation is louder now than at any point since Bretton Woods. And yet, the dollar's share of global reserves has declined over a decade, from about 70% to around 58%. It's down, but it's 58%. The euro is at around 20%. Everything else is noise. No single currency has emerged to even begin filling the gap. Prasad's central argument holds. The trap is not a conspiracy. It's not a scam the U.S. deliberately designed, though it certainly benefits from it. It is an emergent outcome of global financial integration, the network effects of a dominant currency, and the decades-long failure of any other country to build the institutions that could serve as an alternative. The dollar's future, he concludes, is a stable but fragile equilibrium. Everyone is afraid of what happens if it breaks, and that fear is precisely what keeps it from breaking. The very terror of the dollar's collapse is the dollar's best protection. Whether that is reassuring or terrifying depends on where you're standing. The Dollar Trap.